Most people think gold is supposed to rise when the world starts breaking apart. That is the fairy tale. War begins, missiles fly, tankers stop moving, television panels start trembling, and somewhere in the back of a regular investor's mind, one sentence starts repeating itself. Gold should be going up right now. So when gold falls instead, the average person does not he loses his map. He loses the one simple rule he thought would protect him from complexity, and that is when the real damage begins. Because once a man loses the logic he was leaning on, he becomes easy to shake out of the very asset he bought for protection. I have spent most of my life watching people confuse price behavior with underlying reality. They see a stock rising and assume the business is getting stronger. They see it falling and assume the business is broken. They do the same thing with currencies, bonds, real estate, and now with gold. They want one line, one slogan, one moral shortcut. If there is war, gold goes up. If there is fear, gold is safe. If the world is unstable, buy the shiny metal and sleep well. That is not how capital works under pressure. What gets sold first is often not what is weak. It is what is liquid. That is the first thing I want you to understand. Gold does not always behave like a trophy in a crisis. Sometimes it behaves like collateral. Sometimes it behaves like the last clean shirt in a house that has suddenly run out of cash. And if you do not understand that distinction, you will keep misreading exactly the kind of environment you are now living through. Most investors think a war tests convictions. It does. But before that, it tests plumbing. That is the real story. Not sentiment first, plumbing first. When war erupts around a major energy route, the average investor thinks in headlines. I do not. I think in invoices. I think in shipping lanes. I think in which countries need dollars tomorrow morning and what they can sell by midnight to get them. I think in reserve drains, refinancing pressure, and forced conversions, because once you understand those things, the move in gold stops looking mysterious. It starts looking mechanical. People imagine crises as moral dramas. Markets experience them as settlement problems. That difference is where fortunes are made and lost. Let me say something even more uncomfortable. A lot of people who believe they own gold for safety do not actually own safety at all. They own velocity, they own leverage, they own paper promises attached to gold. They own products that feel like gold when the chart is green and behave like explosives when the chart turns red. They tell themselves they are buying insurance. In truth, they are renting acceleration. And acceleration is wonderful right up until the road bends. This is why a violent drop in gold during a war shocks regular investors, but does not shock anybody who has spent time around real balance sheets. The public thinks in symbols, institutions think in obligations. The public sees bombs and expects the safe haven script. Institutions see oil disruption, dollar scarcity, rising yields, forced selling, and they start calculating who is going to the pawn shop first. That is the mother line. In a real crisis, gold can stop being a sanctuary for a while and become collateral for somebody else's survival. Once you understand that, you stop asking the wrong question. The wrong question is, why is gold breaking the rule? The right question is, whose emergency is gold funding? That is a much better question. It gets you much closer to the truth. If a country imports most of its energy and a war suddenly sends oil and transport costs sharply higher, that country does not get to sit around admiring its gold reserves. It needs dollars, not domestic currency, not patriotic speeches. Dollars to pay for energy, food, machinery, shipping, defense, and political stability. If its incoming dollar flows get disrupted while its outgoing obligations rise, it does not have a philosophical discussion. It liquidates what it can liquidate. That is how a central bank gets margin called without anybody phoning it. The public hears margin call and imagines a foolish trader at home with too much leverage and not enough judgment. But nations can get pushed into the same basic corner. Their currency structure tightens, their import bill explodes, their reserve position thins, their peg, their political stability, or their inflation path starts cracking. And suddenly the gold they spent years stacking for strategic independence gets used to buy a few more weeks of breathing room. That is not a change in belief. That is a cash emergency. A man who pawns his watch to pay hospital bills has not decided he dislikes watches. He has run out of time, cash, or both. That is the way you need to think about forced gold selling in a war, not as a referendum on gold, as a referendum on who is out of dollars. Once that process begins, the next mechanism comes into view. I call it the dollar siphon. Every crisis has a preferred exit. In this kind of crisis, that exit is the dollar. If energy becomes more expensive, if rates stay high or rise, if governments and funds can suddenly earn more in dollar paper while uncertainty climbs, then capital starts pulling toward the dollar and away from anything that does not pay. Gold can be loved over the long term and still get hit in that setup over the short term. A lot of investors cannot hold those two truths in the same mind at the same time, so they break. They want one clean, bullish or bearish, alive or dead, safe or dangerous. Real markets do not give you that luxury. A thing can be structurally valuable and tactically punished at the same time. I learned a long time ago that if you need the world to stay emotionally simple in order to stay financially composed, you are going to be expensive to yourself. Now let us move one layer deeper. Once the dollar siphon starts, the rate magnet takes over. Gold does not produce cash flow. That is not an insult. It is just a property. Its attractiveness depends partly on what the alternatives are paying and partly on whether people trust the monetary system those alternatives live inside. When yields rise and the dollar strengthens, machines do not pause to meditate on geopolitical symbolism. They simply reprice. Capital that was happy to float in non-yielding protection starts getting yanked toward assets that offer yield with the appearance of safety. This is where the public story falls apart again. People are taught that war equals fear and fear equals gold. But if the war also creates an inflation impulse, delays rate cuts, raises real financing pressure, and attracts money toward higher yielding dollar assets, then gold can get sold hard before the longer arc reasserts itself. The average investor does not prepare for this because he is using a slogan where he should be using a system. You do not survive markets with slogans. You survive them with an operating system. That is the identity flip I want for you. Most people in markets are tourists. They visit an idea because it feels emotionally satisfying. They buy gold because it sounds prudent, or patriotic, or ancient, or safe. But they have no operational framework for what they own when the world stops behaving politely. I do not want you to be a tourist. I want you to think like a reserve manager. A reserve manager does not ask whether an asset feels right. He asks what function it serves under stress, what can force it to be sold, what kind of holder base owns it, where the leverage sits, and whether the current move is happening in the paper layer or the physical layer. That is a completely different mind, and it is the only mind that can walk through an environment like this without becoming somebody else's exit liquidity. There is another mechanism here, and it is one the public almost never studies properly. I call it the paper avalanche. A great many investors do not fashion sense. They own proxies, contracts, leveraged products, synthetic exposure, instruments that rebalance, instruments that decay, instruments that are magnificent when the price rises in a straight line, and merciless when volatility turns against them. These products are sold to people as tools. Very often they are traps with good marketing. A leveraged gold product is not simply gold with more excitement. It is a daily reset machine. It has its own metabolism. If the price falls, exposure changes. If redemptions accelerate, selling can become reflexive. What looked like enthusiasm on the way up becomes forced pressure on the way down. The holder imagines he is participating in a thesis. In reality, he is inside a mechanism. That distinction is everything. A man who owns a farm and a man who owns an option on a farm are not in the same business. During calm periods, people forget this. During violent periods, they relearn it in blood. When gold falls fast, leverage structures do not merely express the move. They can intensify it. Redemptions create selling. Selling pressures price. Price pressure creates more redemptions. That loop does not care what your original thesis was. It does not care that you intended to be a long-term holder. It does not care that you posted a confident thread 6 weeks ago about buying the dip forever. Machines have no respect for your narrative. They only respect triggers. That is why I have always preferred plain structures to ornate ones. People laugh at simplicity during the party and beg for it during the fire. Now, I want to introduce another mechanism because it matters tremendously. I call it the two-market mirror. There are moments when the paper market and the physical market stop telling the same story. The paper market says panic. The physical market says transfer. The paper market says liquidation. The physical market says accumulation at a discount. If you do not know which market you are watching, you can become hysterical at exactly the wrong moment. This is one of the oldest errors in investing. People watch the quoted surface and forget to ask who is taking delivery beneath it. They watch the headline price and ignore the migration of the asset from weak hands to patient hands. They assume falling price proves deteriorating value. Sometimes it does. Sometimes it merely proves urgency on one side of the trade. A falling gold price in a war can mean many things. It can mean the thesis is dead. It can mean the holder base is fragile. It can mean the paper structure is over-leveraged. It can mean sovereigns are selling because their dollar plumbing has broken. It can mean physical buyers are waiting below and taking everything that frightened paper holders cannot tolerate. You need a protocol for telling those situations apart. Without a protocol, you will always become emotional inside somebody else's process. That brings me to the part most people least want to hear. The long-term case for gold and the short-term pain in gold can both be true. This is where adults are separated from children in capital allocation. A child needs immediate validation. An adult can endure temporary contradiction. If the world is becoming more fragmented, if reserve trust is weakening, if large holders increasingly recognize that paper claims inside the Western financial system carry political risk, if fiscal arithmetic in major nations keeps worsening, if monetary authorities remain trapped between inflation, debt service, and financial stability, then the long-range logic for holding some gold remains easy to understand. But none of that guarantees a straight line. In fact, the very world that strengthens gold's strategic role can create intermittent episodes where gold is sacrificed to satisfy the system's most urgent dollar needs. That is the paradox. And it is only a paradox if you think one asset can play one role at all times. Gold cannot be your strategic reserve and everyone else's emergency collateral without occasionally behaving in a way that insults the people who bought it for emotional reassurance. That is exactly what is happening. Now, let me give you the blueprint I would use if I were trying to think clearly in this environment. First, identify the holder you are really imitating. Are you imitating a central bank, a physical saver, a macro fund, a trader, a levered retail speculator, or a frightened commentator hiding inside a thesis? He does not understand. Most people have never answered that question. They think asset choice is enough. It is not. The same asset owned with different structure, time horizon, and funding source becomes a completely... If your gold exposure is funded with money you may need soon, then your real asset is not gold. Your real asset is anxiety. If your exposure is leveraged, your real asset is reflexive fragility. If your exposure is long duration, unleveraged, and part of a wider cash flow, secure balance sheet, then your experience of the same drop is entirely different. Second, separate the thesis from the path. A great deal of wealth is destroyed by people who were directionally right and structurally wrong. They bought the right story in the wrong vehicle, with the wrong sizing, at the wrong psychological threshold, with the wrong expectation of timeline. Then when the path turned violent, they concluded the thesis was false. No, often the thesis was fine. The owner was simply not built to carry it. This is one reason I have always thought temperament is underrated and financing is misunderstood. A good idea held by the wrong nervous system becomes a bad investment. Third, watch the real governors of the trade, not the theatrical ones. Do not let yourself be hypnotized by the war footage alone. That is emotional bait. The things I would watch are the dollar, bond yields, funding pressure, signs of forced sovereign selling, and evidence of divergence between paper liquidation and physical accumulation. War matters because it sets these things in motion. But the mechanism is what prices the move. That is what intelligent investors miss. They watch the event, they do not watch the transmission. Fourth, keep your own liquidity separate from your conviction. This is so important. If you need next month's security from this month's position, you will always sell too early or hold too desperately. You cannot think clearly when your oxygen is stored inside the trade itself. A good balance sheet is not a luxury. It is the foundation of rational behavior. Men love to talk about courage in markets. Most of what they call courage is just poor cash management wearing a brave face. The investor who can act with patience during resets is usually not the most fearless. He is the least financially cornered. Fifth, build what I call a future self-contract. This is the final safeguard against becoming unstable when price does. Write down in plain language why you own the position, what conditions would invalidate the thesis, what kind of drawdown you are prepared to tolerate, whether you are dealing with a short-term tactical trade or long-term strategic reserve, and what signals you will watch instead of your own heartbeat when volatility arrives. If you do not make that contract in peace, you will negotiate with your fear in war, and fear is a terrible lawyer. Now let me speak directly to the person who feels betrayed by gold right now. You thought you bought a fire extinguisher, and now it looks like the extinguisher is melting in the fire. That is a sickening feeling. I understand it. But if you stop there, you will learn the wrong lesson. The wrong lesson is that gold failed. The better lesson is that you never fully understood the chain connecting war, oil, dollar demand, rates, leverage, and sovereign collateral stress. That is not shameful, but it is expensive. The market is a humiliating teacher because it charges tuition first and explains later. What matters now is whether you are willing to graduate from slogans. A lot of people are about to make one of two mistakes. The first group will say gold is broken and abandon the strategic case entirely because the recent path wounded their pride. The second group will cling to gold with a religious intensity that ignores structure, signals, and timing, and they will confuse stubbornness with wisdom. Both groups are emotional. Both groups are using the asset to protect identity, not capital. I want something better for you. I want you to look at this whole episode the way a serious allocator would. A serious allocator understands that a war can strengthen the long-term case for gold while weakening the short-term price through dollar scarcity, yield competition, forced selling, and paper liquidation. A serious allocator understands that the issue is not just what you own, but what owns you while you own it. A serious allocator understands that price violence does not always mean thesis death. Sometimes it means weak hands were holding the steering wheel, and a serious allocator understands that patience is not passive. Patience is funded. Patience is structured. Patience is a design decision. There is a reason so many people never benefit from the assets they claim to believe in. They only believe in them when those assets are flattering them. The moment the asset humiliates them, they switch sides. That is not investing. That is a search for emotional comfort wearing the costume of conviction. I do not care whether you end this period owning more gold, less gold, or none at all. That is your business. What I care about is whether you start thinking in mechanisms instead of myths, because myths feel elegant right up until they collide with funding needs. Mechanisms, on the other hand, can save you. Let me leave you with the mirror test. If gold falling during a war makes you feel personally deceived, then you are not holding a reserve asset. You are holding a story about yourself. If a drop in price instantly turns you from patient into panicked, then you are not positioned. You are merely exposed, if you cannot explain. In one clear paragraph, the chain from war to oil to inflation pressure to rate expectations to dollar strength to algorithmic selling to leveraged liquidation to sovereign collateral sales. Then you do not yet own a view. You own borrowed language. And borrowed language is one of the most dangerous forms of leverage in the world. The threshold from here is simple. You can remain the kind of investor who needs the market to validate him every week, or you can become the kind of investor who understands what function an asset serves, what can temporarily distort it, what structure best matches his time horizon, and what conditions deserve action rather than drama. That is the threshold. And here is the contract I would make with my future self if I were you. I will not confuse liquidity with weakness. I will not confuse forced selling with permanent invalidation. I will not buy leverage and call it prudence. I will not use a short-term price move to settle a long-term argument. I will not rely on headlines when what matters is plumbing. I will not ask gold to behave like mythology when the world is behaving like balance sheet arithmetic. And I will not let the temporary humiliation of a violent reset stop me from understanding the system that produced it. Because that system is the real asset. Once you understand it, you stop reacting like prey. And when you stop reacting like prey, markets become much less expensive. I have never admired an asset because it made people feel dramatic. I have admired assets, businesses, and balance sheets when I could understand the terms on which they would hurt me, help me, or outlast me. That is a much colder way to think. But it is a much richer way to live. Cold thinking keeps you from making hot decisions. So here is the final test. When the price falls and the headlines get louder, do you reach for explanation or do you reach for escape? If you reach for escape, the market owns you. If you reach for explanation, structure, and discipline, you have started to own yourself. That is the only kind of wealth that survives a real reset.